Volatility is starting to pick up as recessionary fears and the ever-changing conflict between the U.S. and China continue to weigh on the markets.
As Matt just mentioned, volatility crept back into the markets last week because at one point, early on Tuesday, the S&P 500 was down over 3% for the week. But ultimately, through Thursday, the markets rebounded back to about flat. But on Friday, the markets ultimately pulled back a little bit more as the S&P 500, the Dow Jones, and the NASDAQ ended the week down about 0.5%, while the Russell 2000 was down almost 1.5%. Foreign and emerging market stocks were also down last week, with foreign stocks down a little bit over 1%, and emerging market stocks were down over 2%, and now emerging markets are only up a little bit over 3% for the year. Today we wanted to look at a chart of gold, and we wanted to look at gold because in times of volatility that we're seeing like we did last week, investors may be looking at safer assets such as gold over more risky assets such as the equities. And here on the chart of gold, we're looking at a 5-year chart where normally we look at a shorter term, but there's been a long-term resistance level right around 1375 over the past 5 years that was put in on gold. And in June of this year, we saw gold break out above that blue line, the resistance level, make a perfect back test back down to the blue line, and then continue its rally higher. And now we're seeing gold sitting right around that 1500 level and actually a little bit higher as we're shooting this video. So with all the news on tariffs, recessionary fears, and the upcoming elections, gold could continue its run higher as investors may be looking at those safer assets.
The conflict between the U.S. and China began with tariffs, moved to tech companies being banned, and now is evolved into a full-on currency dispute. As last week, President Trump accused China of manipulating their currency and devaluing it. After that, the Treasury announced that they were going to be opening an investigation to an illegal activity of China devaluing their currency. Right after the Treasury had made this announcement, China walked back on their plans to devalue their currency versus the US dollar. The second big news story from last week was that the 10-year Treasury dropped to 1.7%. That's the lowest level that we've seen in over 3 years. Now, this is starting to cause concerns again that the yield curve will invert, and the recessionary fears of 2020 from many analysts are starting to creep back into the news. Lastly, oil entered a bear market officially for 2019, which means that the price of oil has dropped over 20% from its high. This downward pressure on oil is causing a direct lag and underperformance out of the energy sector and also hurting the emerging markets.
With this earnings season already almost wrapped up and most of the economic news already out of the way for the month, the markets are going to be extra sensitive to any new developments between the U.S. and China.
Thanks for watching, and if you're on Facebook, please like and share our video, and if you're watching on YouTube, please like and subscribe to our channel.